Finance can be messy, but don't worry, we clean it up with facts, fun, and maybe a little sarcasm. Welcome to the Financial Sandbox. Don't forget to like, subscribe, and stay tuned for regular real talk in the sandbox. Click the like. I think it's somewhere on the screen. My producer put it somewhere there. My guest today, Mitchell Chernock. I interviewed Mitchell a while back, and we had lunch recently. And one of the questions I really wanted to ask you about was boundaries, right? In when you're in lending and real estate and financial services, it seems that our clients don't understand boundaries, and they'll just call all hours of the day and night or text. You've been doing this 40 years. How have you, and you've raised a couple kids, you're married, I'm single. How and where do you find those boundaries? How do you create them, and how do you let your clients know that I'm always going to be here, but on Saturday night, when the title company isn't open, the bank isn't open, nothing can be done, that you're not available?
You know, I everybody answers the same thing. It's like, that's a great question. The thing is it's actually the biggest part of the picture when you start dealing with somebody. The boundaries are, for me, Monday through Friday, 6 p.m. But I do tell every client, I don't want you to go to bed on a problem. And if you believe it's serious enough, text me and I will choose. And usually, you're never going to get more than one of those at a time. I walk my dogs every night between 8:30 and 9 o'clock. And I tell people, when I'm done with my day, I'll give you a call around 9. And if it's an emergency, I'm not going to send you to bed worrying about it. Other than that, I do take calls on Saturday morning from about 10:30 to 2. And I kind of choose whether or not I will on Sunday. The problem with Sunday, at least in the olden days, that's when every realtor wrote a transaction was on Sunday. So I do have to be available, at least to my realtors, to send out approval letters and do things like that.
Right. Yeah. I work, it's funny you say 10 to 2 on Saturdays. That's about when I work on Saturdays too. And a lot of times that is a time that I find that I get a lot of stuff done. And people are really calm to have a conversation on a Saturday. If you get them on the phone, they're not as stressed out. They're usually more relaxed to answer questions. So we went to a lunch this week, and I loved the luncheon we went to because it was entitled War Stories. But you got war stories from attorneys. So that doesn't exactly, I mean, there's no grenades flying across the room. But you and I have talked about a couple war stories and a couple of crises. What's a crisis in a lending situation for you?
The main crisis for me mostly deals with my self-employed clients, where they are so engaged, they have the money, they have everything, but it's not an investment property. They're buying a home. And, I've got a guy right now, he grossed $2.5 million, and he made like 50 grand. And there's no depreciation to add back. And I even asked him, and he says, well, dude, I don't want to pay income taxes. So, and I would say, a crisis is really when somebody is backing out. But in this particular situation, this is a really large loan. He really has to get it. The seller is engaged, and he has not filed his 2025 tax returns. And I said, look, you need to file real tax returns. Your tax returns have to match your P&L. So we're going to have a conversation about that this afternoon, but they're going to go from showing almost nothing to about 150,000, and he's freaked out about the tax. But the property he's buying will bring him about an extra $60,000 a month in gross revenue.
Right.
It's a crisis for him because he doesn't want to pay it. It's a crisis for me because there's no way I can do no financing at all unless he shows me the real income that he's making.
Right. So let's talk about income and taxes. There are a lot of people out there that are, for all intents and purposes, they don't want to show a huge amount of income, but they still want to buy a house. What are the complications with that? Because when this situation, but how does someone, uh, do I want to use the phrase get around that?
Actually, let's just say that we go right through it. There,
Yeah.
there are two things that have to happen. Peace sign, baby. Is credit and down payment will take away most of any criteria for qualifying. So like on an investment property, let's just say that you're buying an investment property for $1 million and the income on that property, it's a single family dwelling, is $6,000 a month. And your tax returns are pretty much zero, no matter how much money you're making. We would do that as a DSCR, which is also typical of a statement for multifamily, but totally different.
Mm-hmm, mm-hmm.
On a single family dwelling, it's a match on your payment down to 0.75. So here you guy coming in, he's got all of his money, he's got great credit, he's buying a property, and let's just say that $6,000 payment allows him to get a $700,000 mortgage. He's coming in with 30% down, no other qualifying than the rent, the appraisal, his credit, and his assets. That's it.
Mm-hmm, mm-hmm.
And that makes it great.
So that brings up DSCR, which means debt service coverage ratio. So talk about DSCR loans, and because I think there's a lot of loans that seem to be coming back. Even the interest only loans are coming back for people who want to buy a home. One of the things in the late 2000s was we could get a 10-year fixed from what used to be Union Bank at really great.
I loved Union Bank. They were great. Yeah.
They were great, right? So the debt service coverage ratio, describe that, and what is it actually?
So it's an exact, where you want your best pricing, there's an exact match to your payment. If your principal, interest, taxes, and insurance is $6,001 and your rent is $6,001, and let's say that's with 20% down, because it works at 20% down. The appraiser goes out, appraises the property, it verifies the appraisal, he verifies the rent we're going to be charging, especially if the property is vacant and it's a new purchase, because if it's vacant and it's not a purchase, it's a whole different story, which I'm doing right now. I'll explain that to you. But you just match them. The thing is most of these programs are 75 basis points. So let's say your rent is $6,000. Your rent is $6,000. Okay. We know that if your rent is $6,000 and your payment is $6,000, that's a done deal. But what if your rent is $5,500 and you have a $6,000 payment? That percentage difference is still allowed all the way down to 0.75. So that means that you could literally have a $4,501 rent and your mortgage is $6,000 and you still qualify with a DSCR. The difference is just, and I think we can talk scenarios here because we're not quoting real interest rates, is the full qualifier with the DSCR at 100% is 6 3/4 and the other one is 7. But the one at 6 3/4 has very little cost, and the one at 7 might have a point or a point and a half cost.
Right. And people don't understand that point. What do you mean by a point? Is that you're getting a $600,000 loan? That point is a $6,000 cost, right? That's that.
Correct. Yeah. Hey, let's do something really quick. In 2010, prior to the end of the meltdown and the SAFE Act and everything else, you would go in, and I was a broker. So my typical cost was 1.5 points, which, obviously even back then was probably way too shy to make the kind of profits that most people were. But at that point, there's a choice at that point between what's called origination and discount. So the origination is how much we get. But now origination has processing and loan documents in it. So you could literally see a 0 origination, but then you've got a 1.5 discount, and the discount is what the lender investor is requiring. I'm not a broker. I mean, I can broker, and I do.
Right.
But our company has 17 different jumbo lenders, and all of them have criteria, and they're all priced on this wonderful thing that came out of this beautiful organization called FAFA, and that's just a federal organization that sets fees. So a loan with 20% down has far fewer fees than a loan with 5% down.
Right.
And those fees are they're converted to yield. So with 20% down, your interest rate 6.5, and with 5% down, it's 6.625. Might not be a lot, but it's based on your credit score.
Right.
But the debt service coverage ratio is always 0.75 to 1 or higher.
So you just mentioned you have 17 lenders. So what's the difference when someone says, oh, I've been banking at Chase, Wells Fargo, Bank of America? Shouldn't I just walk into my bank and say, I'm buying a house, I need a loan? And
sure.
Because you're a mortgage broker. So I don't think a lot of people really understand the difference between the two lending types.
Three
lending types.
Bank, I'm going to throw these in there. Bank, credit union, mortgage banker, which is what I am, and broker. Brokers hunt for money. I'm a banker. We have our own money. Now, I'm brokering a transaction right now because it is the only way we can get it done. There are a lot of unusual things for it. But take that Chase Bank scenario. You walk into Chase Bank, you sit down with a guy and he goes, okay, where are your tax returns? Don't have any. Oh. Do you have any money at Chase? No. What are you buying? An investment property. Now, depending on where that guy's head is at, it's like, you know what, would you like a cup of coffee and some cookies and open a checking account? Because that's what you're going to get. You have to go to a lender that has non-QM programs, which are just they're not regular qualifying. I've got one right now. 12 months bank statements, get a second deed of trust on your owner-occupied property. So that guy that you walk into Chase and you say, hey, I need to borrow $150,000 against my house. I don't have tax returns. My business brings in $50,000 a month. And like, well, you don't have tax returns and we can't qualify you. You walk into my scenario, we take those bank statements, put them through an income analyzer. It comes back and says your income is X, and that qualifies you, and you're done. I just closed a guy building an ADU on his house because I have very specialized ADU financing. We couldn't use it. 12 months bank statements, and he got $200,000. And that loan was even crazier because it ended up with an AVM. We didn't even do an appraisal. The lender ran their own value, and it came back, no appraisal required.
So AVM, work that acronym?
Average market value. Yeah, average market value.
Okay, so let's go back to the Chase situation. Person actually is banking at Chase. They've got $400,000 in a variety of accounts at Chase. They make $150,000 a year. They do have tax returns. Why not go to Chase? And what would be the difference that you would offer that person in comparison to the Chase situation?
So to be honorable, most people don't know I never use the word fair. Okay, to be honorable with my Chase guys, it depends on what that buyer is there for. If he's there for a standard 30-year fixed rate mortgage, and by the way, if you have $400,000 there, they've attacked you 100 times to be a wealth management client.
Right.
If you're a wealth management client and you don't have something weird going on, I'll drive you to Chase myself. Okay, because they're going to be 1/4 to 3% below the market because they want your money. But one of the things people don't realize is when a mortgage is completed, especially by a regular banker. We did 26 billion one year not long ago, and almost every one of our loans was sold. None of them are sold to aggregators who are banks because they are in direct competition with us.
So when you say Is that
Yeah.
sold to a servicing company who 6 months after you got that loan, you got a letter in the mail that says XYZ Bank is now servicing your loan, and this is where you're sending the payment instead of the original? Is that what you
Right.
mean?
Yes. Now there's something about that is most lenders of our size, anybody, in that multi-billion range, but, isn't like a mega bank or a mega brokerage, that letter goes out in the file, and that loan is usually insured and sold or transferred to a servicer within 30 to 45 days. And it's coming.
Right.
And it's not going to be somebody who wants your checking, your savings, your IRA, your KEO, your children's bank, and it's going to be a mortgage servicer, period.
Right. Right. So what do you, how do you feel about a loan when the bank that grants the loan says we service this loan? And what's the difference between we service this loan versus a random servicer that you wind up finding out later? What's the difference between those two entities?
That's a great question. And I love that to say that is I'm dealing with a guy right now who wants to use his VA, and he wants to go to Navy Federal because they don't sell their mortgages.
Okay.
29,000 years ago, a friend of his had a loan that was transferred, and the guy had 30-day lates, and it wrecked his credit. So, and this is a perfect point for me to say this. There's a 60-day rule that whenever your mortgage is transferred, year, 5 years, you cannot have a late payment during the initial 60 days, because a lot of times those transfers are not affected really well from the agency selling them or taking them. And I've seen impound accounts not transferred, forced insurance policies. So every one of my clients, I tell them, call me when you get the letter. We get on the phone, we verify it's real, and then within a few weeks, we make sure the impound is properly transferred.
Right. Right. And that's the impound we're talking about. Pays the taxes that are due in November and April. So in December.
Correct.
So
and I'm grabbing my water.
That's right. We want to make sure that those things transfer over. There are so many horror stories that you hear from people that the tax bill was not paid by the servicer because the impound account did not transfer over. And the homeowner has assumed it's been paid, and then they get a late fee in the mail. And if you're in California and that those taxes are $5,000 a year and one of them is not paid, that's a $250 fine, right? That's a hefty fine. So when that happens, what happens to the servicer? Do we go back to the servicer and say, hey, I got a late fee, you're going to have to pay it?
Oh, absolutely. And what you do is I tell everybody, when you get that letter, that goes in your loan file, not the circular file. and yeah, because people, I've got it. What if you get your first mortgage statement a month after it's done, and it says balance of escrow 0, you're calling that lender right then and there.
Right.
You have to.
Who paid my mortgage?
Yeah. Yeah. So I mean, even let's say that it was Wells Fargo that bought your loan, or they don't buy a loan, by the way. They buy them in 10 and 20 and $50 million bolts at a time. In order, right. That way we as a lender sell 10 million, we right. make more money. Right. But what happens is that lender is going to give you a mortgage statement well before that 60-day period, and just look at it. Hey, yeah, my interest rate was 3%. It ain't anymore, right? But here's what my interest rate was. Here, wow, my previous mortgage statement with Senlar or with Mr. Cooper, my mortgage balance was X. My impounds was $3,800, and now it shows 0, and it's the middle of summer. We know that the taxes were paid, and there should be something in there.
Right.
And I advocate for every one of my clients. When they call me, I don't say, hey, call customer service. I get on the phone with them and call customer service. And then, yes, all you people out there listening, at that point I say, hey, I gave you a little bit of extra service. Please give me one of your friends, sister, mother, father, brother, aunt, uncle, best friend, or a VIP, somebody who is special and important in your life. And no, they don't have to be doing real estate right now. Just like if I was introduced to you, it's a relationship that I get to start.
Yeah.
And I ask every single time I do something special because I'm not getting paid anymore.
Yeah, exactly. I had to deal with this recently with a client of mine who bought a house about a year ago, and it turned out that the city had added a business tax lien to the property prior to the close of escrow, but it did not get processed through to the title company. So it wasn't until after we closed escrow that they had tagged on $8,000 to the tax bill. So unsecured tax rolls and secured tax rolls, right? Two different entities at the county to get money, and they had attached it to the house. So we had to go back to the previous owner, and the nice thing was that the previous owner realized, yes, I owe this tax bill, I owe this amount of money, and they ponied up a check and paid it. But it was still, it's that servicing thing. I don't make any money from it. I'm handling and managing my client and helping them to get through that process so that they don't wind up paying $8,000 to the city and county that they don't need to pay. So,
well, the beautiful part about what you said, and on my side, especially in any regular transaction where there's title insurance, is I'm calling Old Republic Title and saying, hey, Leslie, this was insured. You guys checked it on Friday. This lien was recorded on Monday, and our file funded and recorded on Tuesday, and it was missed. They're going to go back and indemnify that lien and get it off of there and go after the seller for it as a third party, because that's covered under your title insurance. I'm the only lender and you're the only buyer, and there's no other liens enforced against the property.
Correct. Yeah. And the nice thing was that not only did the title company step up, but the previous owner stepped up right away and said, I'll take care of this. And
no, that's great.
But it doesn't always happen. I've had other clients in the past who a lien shows up and it turns out it's from the previous owner, and now they have to file a claim against their title insurance to get that reimbursed to them, because sometimes they've already paid it and they've paid it in the tax bill. They've gotten all kinds of notifications. So what's the reward for you when you are working on these transactions, this person that is doing a DSCR loan that you're working on now? When you're done, what happens in your house? Do you go out and buy yourself a little gift? Do you buy yourself a tie? Do you take yourself to dinner? Do you take your wife to dinner? What do you do to reward yourself when that closing happens?
So $600,000 transaction, just kind of like being a little bit transparent. And you're not allowed to really kind of push the idea. As you and I, in our meeting the other day, we're real estate brokers. It's weird to have a conversation about compensation, but let's just say that I average making a little bit over a third to a half of what a realtor makes. The difference is I might do twice as much business as a realtor. If I close a regular transaction, whatever I make, I do celebrate with my wife, but we don't do very much. And the reason is that we're not new at this.
Yeah.
Now, if I'm thinking I'm going to close 4 or 5 transactions this month and I close 6 or 7, I am definitely celebrating.
Absolutely.
But these people out there don't know me. So I just came back from taking my wife out to breakfast, and we go out. We're going to go tonight down to Lucca and Benicia and watch 16 Scandals. And we date every Friday night for almost 50 years.
That's awesome.
So if I'm going to do something special, it's usually private and secret, and I'll give something to my wife. I'll throw extra money in her bank account, and she'll go, hey, what's this? I did that about a month ago. I closed a commercial deal for a friend, and I ended up with about a $6,000 referral, and it was a really great transaction for them. And I had promised her I'd do something special, so I put $2,500 in her bank account. She's like, where'd this come from? So it's my idea of celebrating really is to make sure I keep all my planned trips, especially my small ones, and our date night sacred. And once in a while, I'll buy something special for her. I'm not the real estate agent or lender that makes $10,000 on a transaction and believes I have to go spend 8 of it.
Right. Exactly. Yeah. I think too that when I've coached realtors, I always have to tell them, look, you got to remember that you need a pipeline. You have to have that pipeline constantly churning so that you have business going. What's the difference in selling real estate and doing loans? What's that pipeline like? Is your pipeline 3x of a realtor, or how does that work for you as a mortgage guy?
I'm going to answer that question, but I want to say something about what we were just talking about that celebration.
Mm-hmm.
Before I'm celebrating at home, I'm sending out a video to my realtors. I'm celebrating with my buyer, the listing agent if I can, and the buyer's agent, at least doing something nice for them that's not over the top and doesn't violate the rules.
Right.
Okay. So, and ask your question again in a little bit shorter way. I just want to make sure I get it right.
Wow, I got distracted. Oh, pipeline. So
pipeline. Okay.
Yeah, so it's about the pipeline. It's about making sure that you're continuing to keep business going. I find that I've had a conversation and a coaching recently with some realtors that I've been coaching, and I talked to them about not only their pipeline, but their mental, emotional pipeline. Because right now we're dealing with a situation where interest rates went up, people are pulling back a little bit, you've got geopolitical stuff happening, and you have to stay on point mentally, and you have to keep that pipeline going so that you've got, because you're an independent contractor, you're the only person you're the CEO of your business.
So my pipeline is always generally going to be bigger than a realtor, but we have 2 pipelines though. For a realtor, it is listings. And when I was in real estate back in the early 80s, the whole thing is that listings control the marketplace because they bring you buyers and they show that you have the ability to manage a seller. The thing is if you have 10 listings in a slow market, you are spending an average of $1,000 per listing and not making money, which is that pipeline. My pipeline doesn't have to be masterfully priced because I'm not the one pricing it most of the time. A portion of it is coming from Wall Street. But when a seller says, I want $600,000 for my $540,000 house, and you list that property, do you have a pipeline or do you have a burden? So and by the way, if I'm closing 20 to 25% of my buyer pipeline, in order to close 5 transactions a month, I have to have at least 25 real solid leads every single month. And those are leads, 80% of them are getting qualified. They're in my system.
Right.
Rates go up, some of them drop off. Rates go down, more come in. Right. I think that if you have a realtor who's great and they're managing a 3 property ongoing pipeline of listings that is rotating, where they're selling 25 to 30 houses a year in a $500,000 market, where you're doing about 17 million at a standard fee, they're bringing in over $300,000 before their expenses.
Sure.
That they very often don't tell the truth about. I'm sorry, if you sold 12 houses, you didn't drive 35,000 miles. But my pipeline is always bigger, generally speaking, of buyers than they have sellers.
So you mentioned rates, and we talked about it. I like to sometimes talk to people about, what do these things mean? What happens when rates go down, when the Fed lowers the rate, when the Fed raises the rate? And what is that correlation between the regular mortgage rate and what people pay on their home loan, their personal home loan?
Well, let's talk about the effect of prime, because that's the prime rate that's going to change, because the Fed is changing the discount rate. Correct. They're changing the rate that banks charge each other and get money from the Fed from. If that cost goes down and interest rates go down, there's a very special place it used to go down, and we're all getting raped for it. I hate that term. Is credit cards,
Right.
cards and car loans. Okay, so if you go back to the the pandemic, when the Fed lowered rates to 0, you could get a 2 or 3% car loan. Now it's even with a 750 credit score, depending on where you're going, it could be, it could be as high as 8 or 9 or 10%. So, but on a house, interest rates, each move affects each borrower differently. But I refer to it more, and let me I'll do a quick calculation for you, just so that somebody can have an idea, okay? And I know I don't want to get esoteric. I just want to kind of give you something really quick. I'm just going to give you 6% at $100,000 is $600, okay? But now we're at 6.5. And instead of $599.95, it's $635. That's $35, right? Well, if you're getting a $500,000 loan, that's $165 or $70 more per month. And in some cases, it's enough for people to go from a 49 debt ratio to a 50 and they don't qualify.
And what's that debt ratio? We're talking debt ratio. What do you mean by debt ratio? Is it their personal expenses to their income? How does that work out?
So none of your personal expenses are included unless you are a military veteran, and those are imputed in a very special way for simply maintenance and utilities. But on a regular person, if you make $12,000 a month and you're really looking at a debt ratio, we're going to allow you to have all of your credit debts and obligations that show up on a credit report or that are part of your home purchase, such as an HOA dues or whatever, to not, and I'm going to get a little conservative, to not exceed 49%. Because there are 2 programs, Home Possible and Home Ready. Both of those programs, Fannie Mae for a first-time homebuyer, will allow you to go a little over 50% of your debt. So this is where that self-employment or taking write-offs, Herb, you call me up, hey, I make $150,000, but I forgot to tell you, my wife has a car washing business on the side and we took a $25,000 loss. Your income is now $125,000.
Right.
And it blows up and makes it impossible to do that calculation.
Sure. So what happens if we're not going to include the wife's income? And a lot of times people may not, sometimes they have a spouse that's not working or a spouse who's an independent contractor. They don't want to include that spouse's income. How does that affect the home purchase, especially when you have a couple that are probably both going to go on title?
I'm gonna flip this one around on you. You've got a nurse making $200,000 a year and she's working her butt off, and the husband has a $100,000 loss on his business, and it's not an FHA loan. He's just title only. We'll never see his income. Now, here's the other side of that, and I will apply this to a wife. This is very important for people to know. I have a 720 credit score, and my wife has an 800 credit score, but she has no income. That 800 credit score, if I'm putting a minimum down, is actually going to give me better PMI, even though I'm the main borrower. When you have 2 borrowers and one of the borrowers has a better credit score, it's not melded, but you do get lower private mortgage insurance, which is required when you have less than 20% down on most loans.
Right.
So that's a really great question about, not having a spouse. I'm doing 3 deals right now, and all 3 of them, a spouse is title only. They're going to own the property with the husband or wife, but they're not qualifying.
Right. I mean, every transaction is so different, and I think it's what keeps us sharp, because there's no dull moment, and you're always thinking, and that's the fun about this. Is that what keeps you continuing to do this after over 40 years?
Well, there's a couple of things that keep me from doing it. My wife, I want to say something to your audience that's very, very important, because there's a lot of people that are looking out there about what's happening in the Middle East right now.
Mhm.
You and I use different terminology, but we have regained half of all the mortgage bond losses from the day this conflict started, which means interest rates are now significantly lower than they were a week and a half ago. And gasoline prices will be much lower, which helps interest rates. When costs go down, interest rates hate inflation, so they get better.
Right. Right.
Super important to note that. Now let's go back to your original question. I'm going to keep doing that to you.
It's good. It's good. What keeps you to a point where this is still exciting after 40 years?
It is exciting. I love the journey. I like helping people. I have something that kept me in this business longer than I would have normally been. I made a promise to my wife to retire a year ago. Yeah, I know. But part of the purpose and the reason that I didn't is in an agreement that I had with somebody else, there were some things going on that I did not understand. And I had a supreme high level of trust, and I probably shouldn't have. And so I probably got, I hate that term. I'm going to be in this industry probably for at least another year to 2 years. And I want to say that to people because I don't want anybody that's interested in working with us and saying, well, he's going to be gone in a month. I'm not. The chase is amazing. I'll give you a brief example. I'm on the phone yesterday with a 16-year-old girl who's just awesome, and her mother is Burmese and speaks zero English. And the 16-year-old girl speaks Burmese, English, and Spanish. So I told her I was really proud of her, and she helped me through almost the entire application.
Right.
It was fun. I felt, I've got 15-year-old great-granddaughters too.
Yeah.
That's a win. And I told her it was an amazing thing for her. So that's, some stuff is just ultimately really fun.
Yeah. Yeah, it is. It's always fun. There's never a dull moment. I've been dealing this week. My week has been someone who is doing a large portfolio of car washes, and they're selling, and they're trying to figure out the 1031 exchange aspect of it, and what are the steps. And another gentleman who's selling a commercial building, he bought it at $1 million, selling it at $1.8 million. He's taking all of the proceeds, and he's buying a car wash and spending $6 million on a car wash. And when he called me, his broker told him to call me, and his first question was, what's a 1031 exchange? Because I understand that if I do that, I won't pay any taxes on the sale. So I had to walk him through the 1031 exchange steps, process, 101. And he was so excited at the end of the conversation. It is what keeps us going. It is that helping and servicing people and getting them to realize that vision and that dream that they have that keeps us going every day.
Well, it's great, because the extra added statement that I always add, and you're 100% correct, is that you have no taxes on the date of that sale, is, Mr. Jones, we're going to defer all of your federal income taxes on this exchange, because I think some of that is state valued. California is going to try to reach their hand down your throat anyway. But yeah, we're deferring your income taxes. And what if we defer it into an estate, and then later on, after you're gone, the estate does not reach that maximum value? If it's a spouse, that property raises almost completely, I believe, to market value, and then you have no capital gain.
Yep.
And then we've got our wonderful president that we can just pray. He wants to raise the minimum, the capital gain on a family or a husband and wife from 500,000 to $1 million. And the reason they want to do that is we want you to sell your house and move down, but people can't. Who's going to sell their house and pay $200,000 or $300,000 in taxes to have a better place to live?
Yeah, exactly. So when you look at what you do today, and you see younger lenders coming into this space. And it's two sides of the question. If you had something to tell the 30-year-old Mitchell that you can see today, what would you tell him? And when you have young agents and reps that come in that want to get in this business, what do you tell them?
The first thing you must do, let's just say that you're new today, you got your license, you must call every single person that you know. And here's what you're going to say. Hey, Herb, it's Mitchell. How are you doing? I wanted to let you know I made a decision to become a professional real estate agent, not a realtor, not an agent, a professional real estate agent, because people don't know the difference. Or I made the decision to become a financial person, and I'm going to be a mortgage professional. Now, if you've got 100 people in your phone and you never sell them anything and you don't ask them for anything other than say, I need your help, I want to know if I can call on you in the future, you just now made 100 phone calls. Now I have 5,600 people in my phone, but a regular person that's 30 years old might have a couple of hundred folks.
Sure.
And just one of those people he barely knows, but left them a message. They call him back. They go out to dinner Friday night, and their reticular activating system is going, and they're sitting next to somebody. They go, I wish I had a realtor. He goes, I have a realtor. He just called me yesterday.
Exactly.
It's always top of mind, right? And then here's what it truly is. Have VIPs, have as many Herbs as you can, but the only way you can have them is you literally, really have to take care of them.
Yeah.
I can't tell you what I do and hope you send me business. I have to send you business. I have to ask you questions. I have to answer stuff for your client, maybe for free, but you're my VIP. But here's the other big one. Make 100 telephone calls a week. What else are you going to do?
Yeah, absolutely. Right. I interviewed Joe Williams a couple of months ago. Joe Williams is the Williams of Keller Williams.
Right.
And what's funny is what you just said was exactly the same thing Joe said. And you guys are probably of a similar age. You've been in the business about a similar time. Joe's a great guy. And if you want to see that, folks, go back to the podcast archives. The interview with Joe is just fantastic. He is the nicest guy. And I so enjoyed interviewing him. I met him a little over a year ago at an event, and I said, hey, I'd love to have you on my podcast. And he handed me his card and had written his personal cell phone number on it. So it's that people, when they get to that stage, they're just as open to see, how do I help people coming up? And I
want to add something that is so incredible about what you said. I closed my first loan. You close your first real estate deal. Let's start with you as a realtor. You call me up and say, Mitchell, we just closed. I don't need to know anything about the client's finances. What do they have? Oh man, they have a private banker. They have a brokerage guy. They have a trust attorney. Their doctor is their best friend. Would you like me to get you all of those phone numbers? From the client, not from me. The reason it's from the client is, hey, Steve, I'm Herb. I was referred to you by Mitchell. He just closed a financing, and he said you are his go-to finance guy for helping his family arrange their finances and do investments. Do you have a minute to talk? That's it.
That's it.
And if they say no, send them a personally handwritten letter thanking them for getting the phone call, email them back, text them, and then call them again. It's 8 touches to get a yes.
Yeah. It's so funny. I've talked to people like Joel Goodrich, who is one of the top agents at Coldwell Banker, who has sold to billionaires, and it's the same. It's the same strategy. It's the same suggestions on how to get your business going and how to keep it going. Mitch, it's been great having you on today, Mitchell. It's our friendship is starting to grow, and I always enjoy talking to you. I look forward to seeing you in person again, and I'm going to have you on the show with 2 other lenders soon, and I'm looking forward to that interaction. because it's going to be a war stories and a lot of laughter. So I can't wait.
I'm sure. Well, the thing that's going to be great to have 3 lenders on there, each one of us is going to find one thing that the other one doesn't do.
Yeah. Yeah.
And that's a relationship in itself.
Yeah.
I help other lenders all the time.
Yeah. Yeah. One of the guys I'm going to have on, I always call him the James Brown of lending. And people call me and I say, look, if he can't get you this loan, you're not getting it. It's not going to happen. So, and our next conversation, I really want to talk about private money and private loans. So we've got lots to talk about. Thanks so much for joining the show today, folks. That's a wrap.
Thank you, man.
You bet. Don't forget to like, subscribe, and stay tuned for more raw, real financial talk in the sandbox. Thanks again. Have a great day. All right. So we do this twice.